It's 9:11 sharp. My name is Ernest Bodziuk. Hello, everyone. This is the third day of our Warsaw Passive Investment Conference. We know that the conference has triggered a lot of interest, and we have people watching from all continents. So regardless of the time zone, many people are joining us. So for the past 2 days, we had hundreds of people in attendance. The important thing is that people who have not managed or were not able to fit the conference in their schedule and then would like to see that later, they can do it, because on the Warsaw Stock Exchange website and in the social media, we will have the video from the conference. Today, we have 2 panels. The important information for everyone is that we will have an opportunity to ask questions in a chat window to the 2 panelists. At the end of each session, we are going to compile the questions. We will select some questions and we will answer them on air. So at the end of each panel, our panelists will answer some questions from our viewers. The first topic that we are going to tackle today is something that you might have heard of. At the Warsaw Stock Exchange, we have recently had a new listing, ETF, Nasdaq 100 ETF. So the question is, what's up? What kind of foreign exchange risk is associated with such investment? What other things should be considered? So please share your thoughts and questions with us in the chat window. And now it's time to move on to the first topic, and we are going to focus on hedging. Mateusz Mucha and Dawid Bąbol of Beta Securities will discuss this particular question. They are with us, so over to you, guys. Hello, thank you.
Dzień dobry.
Good morning, everyone. We are really happy to welcome you at the third day of the Warsaw Passive Investment Conference. My name is Mateusz Mucha, and together with Dawid Bąbol, we are in charge of managing Beta ETF. Today, we will focus in our discussion about the risk that is affiliated with your investment portfolio. However, as a short reminder for those that have been with us since Tuesday, and as an intro for people who joined us today, let me explain briefly why we do hold this Warsaw Passive Investment Conference and what's the buzz about the passive investing recently. Well, we see the passive revolution of investment funds unfolding before our eyes. What does it mean? It means that the more and more flows go into passive funds or index funds that are actually reflecting or tracking returns of indices such as S&P 500, Nasdaq 100, or WIG 20 total return. So the passive replication can take 2 forms. It could be actually done through the traditional approach, where we have a passive approach of the traditional active fund, or we have a strictly passive ETF funds that are listed on the stock exchange. On the left-hand side, you see the chart that shows the incremental growth of ETFs. 2,400 ETFs with billions of dollars, with $1.3 billion of dollars under management. But today we have 7,600 ETFs and several billion dollars of assets under the management. So this is a tremendous growth. And as a result, we see that in the US, 50% of flows into investment fund flow into the ETFs or index funds. So the natural question is why we have such a shift and why do we see such an evolution going towards the passive side on the market? There are several reasons for it, but certainly the first reason is very low cost involved in holding such assets and investing in such assets. Just if you look at the US market, you see the three bubbles in the middle of the slide, and there is an average cost. The red color is active funds, dark blue ETFs, and light blue, it's traditional index funds. As you can tell, ETF and passive index funds are substantially less costly than active funds. And well, you may claim that the difference is not that large, but that could be confusing or misleading. If you look at the compound interest and take it long term, this small difference translates into huge differences in your investment holdings in the long run, especially if you want to save for the pension and for your retirement. So this is probably one of the fundamental advantages of passive investments that attracts so many investors. And obviously, performance testifies to that. Passive investment is, statistically speaking, a very reasonable idea. Obviously, as an alternative, you may have active management when you are trying to actually beat the index and you want to deliver more than average rate of return. But studies show that the majority of active funds lose against passive approach, against the benchmark, against the index. So take SPIVA study, 77.5% of active funds in the US, I mean, we are speaking about equity funds, mind you, were underperforming as compared to S&P 500 index. And if you look at it at the 20-year horizon, the difference is even greater. Morningstar study showed that 85% of active funds delivered the return rate that was less than the market return. So buying an index was a better investment option than actually investing in 85% of active funds. Active management is a very challenging thing to do. It is less stable. The fund manager may change, the overall philosophy may change. The passive approach is very predictable. We know what is included in the index, and we just track the market, and we build our wealth at the pace of the market development. Another advantages include transparency, tax efficiency, and liquidity. So these are all benefits that come with ETF investing. And today, by investing in ETFs, you have actually access to investment tools that used to be accessible to the professional investors only from the US or London. Today, when you actually take some effort to educate yourself, when you review your assets and your plans, how you want to invest, you may effectively multiply your savings by investing in ETFs. So the world is your oyster, but there is a flop side to that, namely foreign exchange risk, and this is the main focus of our presentation. So investing is about the risk and the rate of return. There is no return without risk. If you get into the financial market, if you want to grow your assets there, you have to swallow some risk. And at any website about investment, you will find actually some attempted forecasting. What's going to go up, what's going to go down. I'm always smiling when I look at it, because when I look at such projections, I think that like these people think that they are magicians of the market. To me, they are like really magicians. It's very easy to come across many projections, and it's cool to read them. This is eye-catching. But if you really want to find like a matrix that would show the actual accuracy of the projections, or some evidence in the form of the actual returns, well, this is much harder to find. And I think that the very thorough analysis of such projections would simply show that the future is unpredictable. Some projections can come true, but the majority will never do so. So projections, let's put it on the side. This is something that is beyond our control, what's going to happen. However, risk management is something that we can do. If you have a structured approach and if you do it consistently, you can substantially mitigate your risk. One of the ways to mitigate the risk is to diversify your portfolio, meaning that you have the various asset classes in your portfolio: equities, bonds, gold, real estate. If you are diversified, your investment risk is reduced. Then within the basket of equities, you may diversify further. You can go tech, you can go banking, you can go gaming. And again, you diversify within this basket. And since the global world we live in, we may also look at the regional diversification and international diversification. If you invest in ETF, you can easily, through one transaction, buy over 1,000 US bonds, 500 US corporations, Japanese corporations, emerging market corporations, you name it. All these investment opportunities are available to you. Whether they are right for you, well, you have to make your own judgment. That should be preceded by thorough education and a plan. But if you want to venture on the international markets, you have to be mindful of the foreign exchange risk. There are three possible scenarios here. You may have positive impact. So let's look at the example. We have an investor investing in S&P 500, so 500 largest US corporations. The investor who's investing in S&P 500 is exposed to these companies and is exposed to the exchange rate risk between the US dollar and the Polish zloty. So the risk may materialize itself. How come? Well, first of all, the US can appreciate against the Polish zloty. And such scenario actually materialized itself back in 2014. S&P went up by 13%, but dollar appreciated against the Polish zloty by 17%. So our return rate from that investment had additional driver. And our total return was at 33%. You may also have a neutral position. In other words, we have no movement on the exchange rate throughout the year. And we had such example when in 2019, when S&P went up by 31%, USD appreciated against zloty by 1%, and the return was actually the same as the US investor would have. But there could be a negative scenario where we have an underlying asset growing by 21%, as it was the case in 2017, but the Polish zloty appreciated against dollar, who was losing strength. And as a result, the entire growth of S&P 500 was offset by the appreciating zloty. So there are three options for the risk to materialize itself. FX risk. It could be additional driver, or it could be actually a buffer that will save you at some point, or it can actually hit you. And it can take away your rate of return on the underlying investment, or it can contribute to your losses. Now, if you really want to understand the foreign exchange risk, you have to take a look at the currency market. The currency market is the largest financial market in the world. And a handful of simple statistics. The annual trading volume on the currency market in April 2019 was nearly 6.6 billion US dollars. And an average daily trading volume in the global equity market globally in Q2 2019 was just 342 billion zlotys. So there is a 20-fold difference. How come? Why the foreign exchange market is so huge? Well, because there are huge players that are playing this game, and they are driven by a number of different investment objectives. First of all, you have the central banks. Central banks have the right to issue their currency, And since economies are globalized and they have trade exposure, we do see such exchange. Central banks have monetary policy, they hold currency reserves, and they also intervene on the currency market, like the Polish central bank. We also have investment banks and commercial banks that hedge themselves or that simply speculate on behalf of their customers or on their own behalf. If a commercial bank wants to lend in the foreign currency, they have to get to the market to buy foreign currency and then to hedge their position. We also have the investment section of the market, where we have investment funds, ETFs, pension funds, and hedging funds. And here there is a very varied landscape. You can have speculations, and this is really the specialty of the hedging funds. The manager would think that some currency is underappreciated or overappreciated, so they can be shorting it. Or let's say that the Polish pension fund would like to invest in the US and they have to buy US dollars first. So this pension fund will get into the currency market and buy US dollars. But in addition to the central banks, there is another important thing about the currency market. The currency market is very much linked to the real economy. You have importers and exporters in the real economy. There is a multitude of companies that buy and sell in foreign currencies, and they have to hedge. So they are very much interested to make sure that they control the currency situation.
Several currencies, or even more than a dozen currencies. And it's worth noting also natural persons, which have a smaller share, but they also are involved in transactions by speculating or selling some sort of baskets of currencies. Next, it's worth analyzing factors that David is going to talk about. I'm not sure whether I'm going to say as much, but I can say that there are a lot of investors who have diverse purposes and targets, and they operate on the currency market. And also, a lot of factors have impact on currency exchange rate. Like Mateusz said, central banks issue concrete currencies, and they can intervene on the currency markets because they have currency or FX reserves. And central banks have impact mainly through monetary policy. They define interest rates in the long and short run, and thus they first of all define them looking from point of view of inflation and responding to it to make sure that inflation is within the boundaries of the inflation target, or what we've been facing recently, and they respond to certain economic crises and try to alleviate their outcomes. Looking at all these factors, and they we can see a lot of relationships and ties here. And even if I were very well prepared to discuss this slide, at a certain point in time, I would get lost because there are so many factors are intertwined and have impact on each other, both in the short and long run. And one more thing that you need to pay attention to is that our analysis should not only involve our country, but also other countries that a given currency pair applies to. So that's another aspect of the analysis, another difficulty when it comes to the analysis of the exchange rate. And there is no single universal model for forecasting a foreign exchange rate. And if there are some quantitative or qualitative models, they mainly focus on one, maybe two factors. So it would be hard for us to find a model that would give us more or less an idea of the right foreign exchange rate. But we can make some estimations, and we'd like to mention one of the models, or actually one of the ways of approaching exchange rate directly related to instruments that we can use to hedge the FX risk. So first of all, there is a difference between interest rate and nominal interest rate, which is equal to real rate and the expected inflation in a given period. So if you look at the long-term perspective, if you look at the diagram and the long-term perspective, where how the FX rate is going to look, we need to ask a question: what sort of factors should have impact on it? There are certain models, assumptions, and studies that have confirmed the efficacy of these models based on interest rate parity and purchasing power parity. These models can be confirmed in the long-term horizon. The long-term horizon is not like 10 years, but decades. So we can assume that interest rates and differences between them have impact on the currency, but in ultra-long perspective. Looking at this diagram, this black arrow shows you where a given exchange rate should go in the long run. So when you are considering hedging FX risk, well, in the long run, whether you hedge or not, in this ultra long run, decades, well, hedging should bring you similar rates of return as in the case without hedging. Well, hedging generates costs. So if you're thinking about long-term perspective, you shouldn't really hedge. Why are we saying that hedging brings similar rates of return in the long run, even if the exchange rate in the analyzed period grows or falls? So why am I saying this? Well, because there is such a thing as interest rate parity. That's the relationship between interest rates and currency exchange rates in both countries of the currency. And the differences in interest rates define the prices at which hedging transactions can be realized with regards to derivatives, to hedge. So the interest rate parity results in the fact that when you hedge, even if when you think that you're hedging a currency at a given point in time at a given exchange rate, you're not really hedging it at a given exchange rate, but at a given future exchange rate. So in the long time horizon, according to studies, according to research, it should behave like this long-term path of a currency exchange rate. Apart from interest rate parity, we also have a purchasing power parity, which is not about a difference in nominal rates, but it's about difference in inflation. So if you have the right exchange rate, if it's placed rightly, in the long run, it should change just as the difference in inflation between the countries. There is such a thing as the international Fisher effect, which tries to take into account both strategies and assumes that the real exchange rate is similar in both countries, which means that interest rate parity and purchasing power parity give similar outcomes. So this diagram should look similar regardless of which parity you use. But in reality, even if that's the case, and Mateusz will show you that it's hard to find something like that, at least when it comes to PLN, because the period under analysis is short and specific. But when you analyze exchange rates, they are not a straight line, even if They follow this long-term path. They deviate one way or another from this path to a larger or smaller extent. If it's to a smaller extent, up or down, it's hard to say whether such an exchange rate is too high, whether given currency is too strong or too weak. But there are certain points in time when the currency goes outside these brackets. And I can tell you about an anecdote about the dollar in 2007, 2008, when the exchange rate zloty to dollar was 2.53 zloty. And I remember the story of my uncle, who has an entrepreneurial spirit, and he wanted to import a car from the States, and he said it was a great deal because, first of all, he was buying cars very cheaply, and when he was flying to the States, well, he went to a restaurant or a pub and he felt like a king. He was a Pole, a regular businessman, but he felt so rich in the States. So this situation showed that the exchange rate of dollar was really very weak. And it's really hard to imagine for someone from a poorer country to come who's coming to a developed country. Well, it's really hard to feel rich. So it goes to show that there are certain deviations from exchange rate. And in that situation, we are able to estimate and say that the exchange rate may be underappreciated. But the future will show us whether we were right or not. And now over to Mateusz. Ladies and gentlemen, every economic analysis has to contain a regressive analysis, and since history on these markets likes to rhyme, it's worth following currencies and how they behaved. We have 5 currency pairs with zloty. We are analyzing British pound, euro, dollar, Japanese yen, and the Swiss franc. So one of the biggest baskets, one of the most popular baskets from point of view of Polish investors. These are the currencies which you can invest in globally. On top of that, dollar. Analysis starting from 2004, when Poland joined the European Union, up until 2008, mentioned by Dawid. The analysis shows you that the Polish zloty was very strong and it appreciated vis-a-vis all currencies, and in those times, dollar costs around 2 zloty, less than 3 zloty. And then there was a financial crisis, a risk aversion, and what was very characteristic for emerging markets. Back then, we were able to see depreciation of the Polish zloty over a very short period of time. So this 5-year zloty appreciation was negated over several months in 2018. So this goes to show that volatility on the FX market, currency market, does happen. And then from 2010, onwards, we can see for all currency pairs, some bigger or smaller brackets in which these currencies were moving. And this is what the next slide shows you. It shows you some volatility. And again, the same currency pairs from 2005 onwards. Before the financial crisis, the volatility was more or less stable. And then we have a significant peak, standard deviation. So you can see when the FX risk came, when the FX risk appeared, which then reduced, and you can see it's on a quite low level, even lower than during appreciation. So the deviations are smaller, but we may see some black swans, some peaks, and you can see it on the example of the Swiss franc, the golden line, when the Swiss franc was released by the Central Bank of Switzerland. And that is why it jumped up, which had impact on Polish citizens who have a credit in Swiss franc. So the currency market can grow very strongly and can be very volatile.
Especially when times are tense. Specifically in the financial sector. From the perspective of the Polish investor, you can see that Euro PLN shows the least volatility. And actually, this is fairly intuitive because our real economy is very much interconnected with the Eurozone economy. Germany, France, etc. So a lot of companies do their business in euro. There is a lot of trade that is denominated in euro. And that's why the euro PLN exchange rate is most stable. While in case of Japanese yen and US dollars, we have the greatest volatility, which is also fairly intuitive. What David has already said and what really matters is how to actually answer our fundamental question, to hedge or not to hedge our investment portfolio. David mentioned the time horizon, and this is the first thing the investor should look at. So are we in the market for a short term, like 3 years, or are we going to stay invested for a long run, over 10 years or for several decades? And therefore, the exchange rate fluctuations do not matter. I rather take it as the currency diversification. And this is the USD PLN history, and this matrix can be quite frightening. However, it's very useful. On the diagonal, so 208 or 2009 with negative 3%. Well, these numbers really show you what was the relation between USD dollar and PLN. So in 2008, USD appreciated against the zloty and the other way around in the following year. So if you were buying dollars in 2008 and you were holding it until 2020, you would be actually getting the exchange rate over 50%, 53%. And in the table, you have annual average. And the annual average shows you that 1 year the dollar would go up, the other one it would go down against the zloty. And at different time horizons, you may actually have a different FX impact on your portfolio. And the same is shown here. From 2004 until 2008, we have a 41% drop in USD against zloty. So the Polish person could feel very wealthy while traveling to the US. And then the trend reversed. The zloty started to depreciate and the dollar was appreciating. And 108%, it was over the period of 8 years. And in the tables, you see the maximum increase in dollar against zloty and against zloty against other currencies. So you see that USD PLN 91.77%, it was a tremendous driver for people who invested in the US. But if you had the US investors coming to invest in Poland, they suffered. And at the bottom, you see the maximum drops in annual periods for different currency pairs. So even during 1 year, the fluctuations in exchange rate can be quite substantial. But if you look at the US dollar, the 15-year horizon shows only 8% increase of the US against the zloty. So, as a matter of fact, it doesn't really affect your portfolio. Whether you take your return rate in dollar or in the zloty, it will be fairly similar, because in the long time horizon, the change is really minor. So the fundamental question is, what is your investment time horizon? Okay, Mateusz was talking about the risk, but he was referring about the foreign exchange risk. While for us, the foreign exchange risk pops up when we start investing in international asset classes. So the foreign exchange risk should be analyzed in the context of your underlying investment. And again, take S&P 500 as an example. First, let me take you to the right-hand side of the slide. Here we see the return rate on the USD PLN exchange. And from 208, at 208 we were actually starting from the low level and the average return rates were positive. So you may ask the question, did it make any sense to hedge your investment? As Mateusz said, what really matters is the investment scenario. Because and investment horizon. If you actually invested in 2008 and you were holding it until 2020, you made a positive return on FX risk. But imagine that you get into the market at the end of 2016. And as you could tell from this chart or the previous metrics, we had a negative impact from the foreign exchange risk materializing itself. But as I said earlier, the foreign exchange risk should be reviewed in the context of the underlying asset. If you look at the left-hand side chart and you compare S&P 500 from the US dollar investor, and this is the dark blue bars, or you see what is the exchange rate from the perspective of the Polish investor, who's actually investing in Polish zloty, well, you see that there is positive or negative impact on your performance. So when the times were tough in the financial market, at least from the perspective from S&P 500, quite often the US dollar was appreciating against other currencies because dollar was considered to be a safe haven, and investors were actually switching to the US dollar. Now, so during the tough times, having the exposure to the US dollar was actually mitigating negative impacts of the market panic or the overall bad sentiment or bad trend. But in the other years, when indices were showing quite a positive rates of return, well, the Polish investors were either getting up or down with their return, depending on the foreign exchange situation. So it's really hard to predict, and it's hard to say which way the risk will materialize itself. So the shorter the horizon of your investment, the more susceptible you are to the foreign exchange risk. Now, let's get to the another equity index, Nasdaq 100, so a different chart and a different context. And here we want to draw your attention to volatility. Now, look at the Nasdaq 100 and volatility seen from the perspective of the US investor, so in US dollars. And now let's take a look at the volatility for the Polish investor and the Polish zlotys. In this case, the standard deviation for the equity index, so for an asset that is highly volatile by nature, well, this standard deviation is not very different for one perspective of the other, but you actually see the difference in the final rate of return. This is a 5-year horizon. If you look at the start point and end point, the US dollar depreciated, and therefore the Polish investor was getting less in their returns. It really makes sense to highlight the fact that depending on the asset class that you're going to invest in, the US dollar volatility can be either high or low for you. That will be better illustrated by the next example. But let me also say that many times we are investing cyclically. And let's say that we actually do some averaging and we invest similar amounts on a regular basis. So we do a dollar cost averaging, like here for Nasdaq 100. But at the same time, we are also averaging the exchange rate at which we are buying the currency to invest in. So this strategy actually shows that you can decide to follow a more risky approach, and you may decide to waive the hedge on your FX risk, but it all depends on your investment horizon again, and it depends on how regularly you invest additional money in your portfolio and how often you actually take the money out of the market. Because if you average the exchange rate throughout the years of your investment, and if you have the single exit, nevertheless, you are still exposed to the foreign exchange risk, and therefore the average exchange rate is dependent on that particular moment in time when you are cashing in. So if you are investing for your down payment on your home, and at some point you are actually going to buy a home and you take all the money out of your portfolio, so when you were averaging the exchange rate throughout your investment time, nevertheless, you actually cashed in at a single point in time, and you are still exposed to the risk. Now, if you actually spread your exit over time, then you are averaging the exchange rate at which you cash in. And if you keep thinking about the exchange risk from that perspective, you can actually claim that perhaps you would be less impacted. But like the more concentrated your investment is in time, both in terms of getting into the market and getting out of the market, the more aware you should be of your foreign exchange risk and whether you are able to absorb it. Now, on this slide, you see the foreign exchange risk and volatility of investments that depend on the type of assets you're investing in. So this is the bond index. And let's imagine that we don't see the black curve. Let's say that we see only the red curve and the green curve, just the same, but during the previous discussion, previous slide. So again, the US investor is red, and volatility for the US investor is quite desirable because this is 6%, give and take. So this particular asset is not that volatile, and this is what we would be expecting from the bonds if this is our asset of choice. But now, if we are investing from the perspective of the Polish investor, we get a different story here. This is a much greater risk. The volatility is nearly 15%. So if you look at the risk components, when you invest in international assets, this is a function of asset class volatility shown in the foreign currency and the exchange rate between your local currency and the currency at which you invest. And many times, in case of two indices, like Nasdaq 100 and IBEX USD Liquid Investment Grade, if you look at the correlation between the two indices, it is slightly negative. So the correlation between the underlying asset and the exchange rate. And therefore, you may assume that the risk for the Polish investor is the maximum risk of the FX risk and underlying asset risk, plus additional percentage points. So if the Polish investor gets 15% as a rate of return, 13% is like Polish zloty to dollar. So if you invest in the foreign index that is currency hedged, you take on exposure not to the index itself, but to the currency in which the index is denominated. So it makes sense to really think beforehand whether we are up for such a volatility in our portfolio and whether we really want to have it in our portfolio, if these assets with such volatility. It's hard to say what would be the final scenario for the Polish investor if he was hedging. I've already mentioned the interest rate parity, which determines the future rates or prices of the derivatives that you use to hedge your position. If the interest rate in Poland is higher than the US interest rate, if you hedge, you get the return rate on the US index and the interest rate differential between the US and Poland. And when we have it the other way around, like today, then we get the return rate on the bond index minus the interest rate differential. Therefore, the international investment in the bonds gives us the same rate of return that we should normally get in Poland, very roughly. So if you look at the black curve and the red curve on this chart, at the initial period when the interest rates were fairly high, hedging would boost your rate of return. But moving on in time, when this difference were obliterated, and now actually it's to the benefit to the US as of today, and you hedge your position, then you're up for the losses.
And now, how can we hedge? From the perspective of an individual investor, you can conclude futures on the Warsaw Stock Exchange. It's no problem to do that for small amounts. We have 4 currency pairs that you can do that. But if you're hedging your position, you mainly hedge with derivatives, so instruments that have a specific expiry date, which means that if we were to prolong our exposure to those assets, we need to roll over these contracts. So with each transaction, you have either a broker's commission or spread, and it's important to take the multiplier on the Warsaw Stock Exchange is 1,000 units. So for less than $1,000 US, you are not able to hedge your position. On the other hand, we have currency hedging offered in the form of products, active investment funds or index funds, for example, Invesco. And we can check whether the currency risk is hedged, looking at different documents. It would be best to look at financial reports. And we also have one product on the stock exchange with currency hedge for NASDAQ 100, S&P 500, and soon we are going to have another such instrument. So we are often asked about costs of hedging, and they can be broken down into 3 groups. The difference in short-term interest rates, and that can be considered as cost or not, simply as a positive or negative rate of return, depending on the time horizon. So your exposure to those exchange rate differences depends on the time horizon, and you were able to see that on the example of the diagram. There are also transaction costs, and it's important what kind of currency pair you're hedging and when you're doing it, and this determines the size of spread and the frequency of rolling. So how long is the expiry date of the derivative which we use to hedge. And either we have to incur transaction costs more frequently, and you have to consider the quality of hedging and the period. Let's say I have a $1,000 investment and I want to hedge it. I want to invest for 1 year. I want to hedge FX risk. So what would be the amount I want to hedge? Instinctively, one would say $1,000. But after a year, the value of this investment can be 1,000, 1,100, or 900. So if we are concluding the contract today for a year, it's hard to define a hedging value. So the more frequently we roll over, we incur transaction costs, but at the same time, we are able to better adapt the hedge. And there is a base between currency, the demand and supply for the instruments that we use as a hedging. Some solutions are cheaper, some are more expensive. If we are on the dominant side, then we are slightly losing. If we are on the reverse side, we are winning. And also, transaction counterparty matters. It has impact on the conditions that we get. It's not only us, Poles, that are thinking about hedging from FX risk. That's an example showing you that there are several products, well, quite a lot, several hundred products with such FX hedging. Swiss franc is not present here, but you can see that there are quite decent assets here. So it's not only us thinking about hedging FX risk, also investors in other countries are doing this. So it's worth considering the FX risk we are exposing ourselves to. The managers using this hedging know that, but an individual investor might not see this as intuitive. Let's say we have an American market ETF. Underlying assets are quoted in dollars and it's quoted in euro, and we are from Poland. So what sort of currency are we exposed to? Euro, because the debentures are quoted in euro, or is it dollar? If you look at the top right of the table, you will see FX rate at the beginning and then the end, the assumptions. And at the bottom, the assumption is that ETF in dollars, the underlying investment hasn't changed its value. The value was zero, but because of the fact that euro-dollar exchange rate changed, and the quotations of ETF changed their level, even though the underlying investment hasn't changed its value in underlying currency. So you can see how we lost 4%. But if you look closer and you change from euro to zloty, you will see that effectively our rate of return on this currency per dollar zloty. So the FX risk is not really related to the currency of quotation, but to the currency of underlying assets that the ETF is investing in. And now, just additional information. We are using synthetic replication. I think our colleagues from the next panel will say more interesting thing about this. We are using synthetic replication using index futures. And that's why our exposure is 100% with regard to index futures. And this determines the assets of our fund. Some 80% of funds is in Polish zloty. So safe investments, deposits, bonds, it's in zloty. Dollars account for 15% of the portfolio expressed in zloty, because the 15%, well, we need it as a security deposit to hedge transactions on futures. So if we have a currency-backed transaction, we don't have to hedge 100% of the value of the portfolio. We're just hedging those 15% of the value of deposit, because that's our exposure. And because when you invest in futures, it's not really a buying or selling transaction. It's just taking position. So as a result, there are no flows. So with futures, you don't have to invest dollars. And also when you cash in, you close the transaction, there's no flow of funds. So there is no FX risk for the whole portfolio. And Mateusz, over to you. Thank you, ladies and gentlemen. We are closing to the end. It's time to answer the question, to hedge or not to hedge. That's the question. And what are the factors that determine this? Well, the most important slide summing up the whole presentation. What does it depend on? What should you invest as an investor, analyze as an investor to answer this question? And there is no single answer that would be right for everyone. Well, the currency of the investor. Some of you may be global citizens and get your money in euros, in pounds, or maybe you have a portfolio of currencies in your day-to-day life. So, in the case of such investors, hedging doesn't really make sense because your day-to-day life is so diversified that it does make sense. Simply those currencies in your portfolio are a form of diversification. We mentioned investment horizon. The shorter the horizon to get a given rate of return on a given index, the more you should consider hedging, FX hedging. And if we are investing in long-term financial assets, you're diversifying. But if you have an investor from Poland who's calculating everything in zloty and always sticks to zloty and also wants to invest in the long term, thinking in zloty, PLN hedge would be a right thing for him. Dawid analyzed the aspect of risk and underlying assets. It's very important, especially in the case of bond index, because if you are buying a bond, you will have diversity. You want to have diversity, and if you add bonds with currency risk, then on the example of iBox shown by David, the volatility was almost the same as an equity market. So this is not really something you want to have in your portfolio when you're buying bonds, because often bonds are supposed to limit this diversity. They are supposed to be a safe haven. And also cost of hedging, possibility of hedging. Some investors do it individually, but there are also ETF offers like Beta Security in cooperation with Agio has such products, and in the nearest weeks another Beta ETF for S&P 500 to offer full hedge. And the last slide, just to sum up, investing abroad is a very good, effective form of diversification. However, it's related to certain FX risk, which one should analyze. Currency hedging, whether it's determined by the currency, investment horizon, assets, and costs of hedging. Investors may try to individually hedge their currency, their FX risk, for example, futures, or connect the products with FX hedging. And there are also euro hedged ETFs where euro exchange rate is hedged versus dollar, is hedged to dollar. ETF PLN hedged offer was offered for the first time by Beta Security. So it's Beta ETF, Nasdaq 100, and in the nearest weeks we will have Beta ETF S&P 500 PLN hedged on the Warsaw Stock Exchange. That's it from me, and over to Ernest. If there are any questions, we are happy to. Yes, we have some questions to you, gentlemen. Let me start by referring to what you've just said. You mentioned Beta ETF, S&P 500. You said soon. When? Do you know a concrete date? Because there is a question when you are going to launch this product. Can you let us into the secret? Greetings to all employees of the Financial Supervision Committee.
datem bieżącym zostanie ta data podana.
We will quote this date soon according to the rules, so really quite soon. We are finishing certain formalities. It's a matter of weeks. Another question, what about investing? We were talking about currencies. What about investing in currencies directly? In dollars, for example. Mateusz, you can answer. Thanks, Dawid. Well, investing in currencies, you have to remember that buying currencies in the bank, for example, is related to a loss because there is inflation. So purchasing power of money shrinks over time. Money does not work for us. But of course, it may happen that dollar will become stronger and that we will have a real rate of return and that we will win against inflation. But buying currency itself is an individual matter, of course. But in my personal opinion, investing in financial assets means keeping a certain reserve in a currency, but I would focus more on financial assets. Okay, my favorite question, and I guess a lot of analysts like this question, what will be the exchange rate euro to dollar? I wanted to ask. You can euro PLN and USD PLN at the end of 2021. Referring to the presentation, I am not a magician, market magician, so I leave this to for other people to decide. I focus on risk related to investments, and simply, honestly speaking, the answer is I don't know. If we knew, we would be rich at the end of the year. So another question for dessert, last but not least. This is the period of tax settlements. What about tax settlements with such investments? Do we see this in our declarations, tax declarations? Partly, yes. All brokerage homes, all brokers already provide you with a tax declaration which is already filled in, and it includes exchange rate. On the one hand, the declaration is based on assets that we bought in foreign currency, but the foreign currency at the time of buying and selling is valued at using average exchange rate of the central bank. So if we earned money, if we had some positive return, we had to pay some tax. If not, then no. But the tax declaration is taken into account by Polish brokers. And that's the end of our Q&A session. Thank you very much, gentlemen, for this very interesting presentation. We spent an hour together. Mateusz, Dawid, thank you so much, and stay with us because it's not the end of our today's meeting. Now it's time for another session. Now over to Michael Huber and Markus Poscher from Invesco, who are going to focus on the most interesting instruments of American companies. They will mention ETFs related to ESGs.
Now it's time for Michael Huber and Markus Poscher from Invesco. They will talk about the most interesting instruments based on equity stocks on American companies. This is, of course, only one of the topics. After your, hello, gents. After your presentation, we will have a short Q&A session. So, Markus, Michael, the floor is yours, or maybe I should say the screen is yours.
Thank you very much, Emmett. Thanks a lot for this very kind introduction. Apologies, our Polish is not that great, so please bear with us in speaking English to you. thanks a lot for dialing in today, and thanks a lot for your interest in ETFs in general. And we are fully convinced that the efforts undertaken by the Warsaw Stock Exchange now for the second edition of this Passive Investment Conference will really help in bringing passive investment solutions to better understanding to investors out there, be it professional, be it retail investors. And so thanks a lot, and big kudos from our side here to the organizers also of this event. And I'm sure you have already had a lot of interesting insights. Also, I guess the last presentation from our friends from Beta Securities, from the little what I understand, sounded quite interesting to me as well, and hopefully it did provide a lot of value to you. So what we intend to do, and that's for the next 50 minutes or so, my colleague Michael and I will introduce you very briefly to Invesco, then talk through the efforts, or give you an overview of the market in general on the ETF side, then have a closer look on the different means of replication, and finally touch on the all-important topic of ESG. So in order to set the stage, Invesco is one of the largest leading independent asset management companies out there. So we are independent. We are not part of any insurance or banking group. We manage close to $1.4 trillion in total, in active and in passive investments. And you see here that a quarter of that is now already and strongly growing in ETFs, or ETPs as we call it, which includes ETFs and then ETCs and ETNs, which we'll touch on a little bit later on this. Where Invesco, what we stand for, is we're the fourth largest provider globally. We do all replication methods. That's also the reason why we want to stress this in today's presentation. We're certainly a cost leader in many of the asset classes, and we do offer a range of more than 135 UCITS ETFs and strongly growing. So that's in a nutshell what we stand for. May I just introduce the two of us to you? So my colleague Michael here, who will do the heavy lifting today, who is the ETF expert in our team here, responsible for coverage of Central and Eastern European investors, especially here in Poland. So he's part of my team. I'm heading the general distribution efforts of Invesco here in the region. And so the both of us will walk you through today's presentation. I will ask a couple of questions to Michael, who will then answer to this. And at the very end, then be looking forward to really receiving your questions, the topics that are of interest to you, and where we might be in a position to hopefully provide some clarity and some guidance to you. Here. So let's start with the market overview before touching on the other subjects. So Michael, please be so kind to share with us a little insights on where the ETF industry in general stands these days and what trends and developments you have noticed.
Perfect. Thank you very much, Markus. So hello from my side as well. I'm really honored to be able to speak on this fantastic conference. As Markus highlighted, we wanted to start with a brief overview of the ETF market. So what you will see on the current slide is basically a global picture of the ETP landscape. So ETPs will be explained a bit later. It's just exchange traded products, so mainly ETFs and ETCs. When we look at the global picture, you can see that the ETF assets have grown quite tremendously, and at the moment we're looking at around $8 trillion US dollars invested in ETPs globally. But also the growth rates are really impressive. So the year-over-year growth rate was at around 26%. Looking at a slightly longer time frame of around a decade, you will see that the growth rates are quite constantly at around 20%. That means that the assets in ETFs double every 4 to 5 years, which is definitely a great development. Looking at the largest asset pools, you can see that the US is by far the global leader, around $5.5 trillion in ETFs, followed by Europe with around $1.3 trillion US dollars in ETFs. And the biggest growth at the moment is definitely in Asia Pacific, around about 50% year-over-year growth in the last year. Looking at the European ETF market, the UCITS ETF market in a bit more detail, you can see on this slide the top 10 providers for UCITS ETFs, so European ETFs. There's a couple of observations that are quite interesting. So when we look at the bottom of the list, you can see that those top 10 providers account for approximately 90% of the assets that are invested in those ETFs. So it's heavily tilted towards the largest providers. iShares, BlackRock, for sure, the leader in most global markets with a market share of around 44% in Europe. We as Invesco rank number 7, and don't get confused with the numbers. So what we show here is just the European ETF numbers, the UCITS numbers, and we manage around $50 billion in UCITS ETFs. What we also wanted to highlight on this slide is a large overarching trend that we observed in the recent years, and that's a strong growth in demand for ESG ETFs, so ETFs that address some sort of ESG topics. What you can see in the bottom half of this slide is basically that last year around 40% of the ETF flows were in ESG ETFs. And that's even more spectacular when you look at the overall asset base, which is at the moment still comparatively small. So only around about 8% of the overall European ETF markets are allocated in ESG ETFs. Still, those 8% made up more than around about 40% of the flows last year. Looking a bit more into detail of trending topics and topics in 2020, you can see on top of the list that ETF flows were predominantly driven by what we would call standard building blocks, so basically regional or country-specific ETFs that give investors exposure to a certain market, followed by precious metals, that's mainly ETCs. When we look into a bit more details, what you cannot see on the slides, the precious metal bucket is predominantly driven by investments in physical gold. So a huge demand for gold investments, especially last year, gold as a safe haven. And then there's two surprising outliers in this top half of the chart, and that's thematic ETF and China bond. Both themes were not really en vogue in 2019, but they saw a big increase in 2020. And the demand in those ETFs has really been phenomenal. Looking at the region and country-specific ETFs in more detail, that's the lower half of the chart. You can see that flows were predominantly in global equity ETFs as well as US equity ETFs. Followed by a strong demand in China. And again, some things to highlight. So the demand for emerging market ETFs and for European equity ETFs saw quite a decrease compared to 2019, which is definitely worth highlighting on this slide.
Thank you, Michael. I guess that sets the scene quite well in the environment that we operate in. And the beauty of the ETF market in general is it's very transparent, and those data are relatively easy accessible for everybody who's interested in, probably much more than a traditional mutual fund market. So that makes these kind of statistics quite interesting. Michael, you have touched on two topics in particular, and maybe you can share a little bit more light on this, which is ESG and thematic.
Absolutely. So as I've highlighted, the two big overarching trends were a strong increase in demand for both ESG and thematic. Sometimes it's not that easy to draw the line because, for example, if you take a clean energy ETF, is this ESG or is it thematic or is it potentially both? But what you can see on this slide is that both ESG and thematic ETFs saw significant growth in AUM. Both more than 100%. And what we try to highlight on the left hand side of this chart is the flows throughout the year. So what you can see there is highlighted in purple the thematic flows, and they've been quite constant over the full year. So constant demand from different types of investors, both retail investors but also institutional investors. When we look at the ESG flows, on the other hand, you can see a strong pickup in demand towards the second half of the year. And this increase in demand is still going on. So also in 2021, ESG ETFs have been highly in demand.
Thanks a lot, Michael. I guess it's really interesting and certainly something to follow on and to focus also for you reading the news on the development of the markets. So this is really, I guess, two important topics. So if you may, we will come now to the first major section of what we intend to show and explain to you today. And that is, we call it outperformance through smart replication. What we intend by this catchy title is to tell you that underneath the ETF wrapper as such, and especially by talking about equities, there's a lot of insights that you need to know between the different forms of replication, be it physical, be it synthetic, and there are kind of subforms how you structure those things, and that's something you need to look on at very, very efficiently. So we're a long day off from those kind of structures before the great financial crisis. So I guess for every major player out there, I guess you are in a very good position and in a very safe position regarding counterparty risks, liquidity, and all those things. So I guess that you can take this more or less for I wouldn't say for granted, but it's very high likelihood that with all the major players out there, you in best hands. But what we intend to show here is to really get a deeper dive into this, and Michael will explain this to you in a second in much more detail. What I just will provide here is with that page, and that's something we have now mentioned twice already in the introduction, that the term of ETPs, so exchange traded products, consists of three different classes, which we sometimes tend to, commingle and take one for the other. The most important topic and the most important category is, of course, ETFs. So that is principally funds, exchange-traded funds on liquid assets, so especially equities, bonds, and the likes, so which are mostly talking about. Then you have for assets that are not liquid instruments as such, like commodities, and gold was already been discussed here briefly. So for you use an exchange-traded commodity, which is a different structure. It trades the same way. It's the way you operate as an investor is exactly the same way, but in its legal form, it's a different animal. It's we call it here a bearer debenture. So it's a debt note basically issued by a company, and that exposure is then physically backed by the commodities. And lastly, exchange rate notes. These are then ETNs, so products where we can wrap instruments that are not part of the first two categories. For example, bank loans. Invesco is one of the has a major bank loan ETF in the US, for example. So loans which are, this is not really part of the liquid instruments, need the commodity. So that would be understood as an exchange traded note. But that's enough from my side. Over to you, Mike, to really get more into the beauty and the underlying differences in the different methodologies of index replication, especially here on the equity side.
Absolutely. So to make it clear, what we show on this page is referring to ETFs, so exchange traded funds, not ETCs or ETNs. And the target of most ETFs is basically to track an index. So what we tried to illustrate here is how an ETF can achieve that goal and track the target index that it wants to track. So we're showing you quite a simple equity index here, comprising a number of stocks. And when we look at the different replication methodologies, there's basically two ways of replicating this index. One is physical, the other one is synthetic. Starting with the physical replication, probably the most simple way of replicating a stock index is the physical full replication. That means that the ETF holds each of the stocks of the index in the portfolio, and each of those stocks in the respective weight of the index. So really straightforward, because the ETF portfolio really mirrors your index exposure or your index constituents. Physical full replication can get a bit tricky or a bit expensive if there's too many stocks in the index. So thinking about a really, really broad stock index with a couple of or more than 1,000 names, it's not necessarily the most efficient way to trade each of those stocks, especially when the quota or the weighting of each of those stocks is extremely small. So in this case, an ETF manager has the possibility to use optimized sampling models. When it comes to optimized sampling, again, the target is to track the target index as closely as possible, but the ETF manager will not hold each and every index constituent in the ETF. He will try and find a proxy for a number of stocks, and that's what we try and illustrate on this slide. The second way to replicate an index is the synthetic replication. And there's a lot of misunderstanding around synthetic, because synthetic does not mean that you're not holding anything in your portfolio. It's more the case that you hold a collateral portfolio, usually a stock portfolio, inside your ETF. But the beauty is that this portfolio does not necessarily need to be exactly structured like the index. It can look quite different from your target index. What the ETF manager then does is he enters into a swap contract with an investment bank and agrees under this contract that the investment bank will provide the ETF with the target index performance. In return, the investment bank will receive the performance of the collateral portfolio. So the synthetic replication brings a number of advantages. One advantage is that the tracking is extremely precise, even in volatile markets. Because the target index performance is delivered from a bank. It's a contractual, it's a contract between the ETF and the bank that the ETF will receive the target index performance. But there's a number of additional advantages of the synthetic replication that we want to touch upon on the following slides. One of the major advantages is that there are certain markets where you can generate a tax benefit through a synthetic replication. And the best example is potentially exposure in US equities, because as an investor, when you hold US equities in your portfolio and you receive dividends on the stocks that you own, the US tax law will apply a withholding tax of 30% on those dividend payments. That means you as an investor will not receive the full dividend payment, but only 70% of the amount that is paid out by the company. 30% are reduced because of this tax burden. When you do invest in an ETF that uses physical replication, the withholding tax can be reduced based on double taxation agreements, basically between the country of domicile of the ETF and the US. And you can bring down the withholding tax quite significantly from 30% down to 15%, so you can cut it into half and therefore generate some outperformance. Talking about synthetic ETFs, that advantage is even larger because there's an official US tax law, the so-called HIRE Act, that has the target to basically make swaps comparable to futures, and helps you to bring the withholding tax down to 0%. So in a synthetic ETF, you are not forced to pay any withholding taxes to the US tax authorities. What we show you on the left-hand side of this chart is basically a performance comparison, a relative performance comparison of the largest S&P 500 ETFs in Europe. So you can see the x-axis highlighted in green. That's the benchmark, the S&P 500 Net Total Return Index. Net total return means that the index includes all withholding taxes. So basically, whenever a dividend is paid, only 70% of this dividend gets reinvested. What you can see in the chart is that each of the ETFs show outperformance versus this net total return benchmark. There's two physical ETFs from Vanguard in iShares highlighted in gray and orange. And those ETFs generate an outperformance between 20 and 25 basis points over the last year. On top of the chart, you see a group of synthetic ETFs from different providers. And you can see that the outperformance of those synthetic ETFs is round about twice the outperformance of the physical ETFs. The reason for this is exactly the withholding taxes and the benefit that you do not need to pay those withholding taxes in a synthetic structure. Looking at this chart, you might get the impression that as an investor, you get paid for an investment in an S&P 500 ETFs because you generate outperformance, and apparently the costs are already included in this chart. So what we wanted to show you on the next slide is that it's basically just a question of benchmark. If you see an out or an underperformance in a relative performance comparison. So what we did on this slide here is basically we switched the benchmark from net total return index to the gross total return index. The gross total return index does not include any withholding taxes, so it's the best possible outcome that you could have as an investor, because it's not including taxes, it's not including any trading costs, so it's a theoretical index that you may or may not achieve. So compared to the gross total return index, every provider shows an underperformance. What's quite interesting in this chart is that it becomes clear that there's different models of crediting this outperformance to you as an investor. So whenever you see a straight line, that means that the ETF provider uses the gross total return index as a benchmark and basically promises you as an investor gross total return performance minus a fee. Whenever the line is a bit more erratic, you can assume that the ETF provider uses the net total return index as a benchmark and then credits an outperformance into the ETF on a regular basis, so usually daily or monthly. We decided to show a 2-year or a 3-year track record here because it makes clear that a lot of ETF providers changed their models. So you can see that Luxor and Amundi both changed from the net plus to the gross minus model. And at the moment, basically only Deutsche Bank X-Trackers is offering this net plus model. Talking about outperformance in a synthetic replication and changes of models, it might also be interesting to look at a longer history of outperformance and how outperformance can change over time. So basically what we want to highlight on this chart, and this chart shows you the 12-month rolling outperformance of different providers, is that whenever you pick a product that seems to be best, it's worth really having a closer look at this position over time and rechecking your decision quite frequently, because outperformance may or may not change over time. So looking at the green line, for example, you can see the outperformance is building up quite nicely, followed by a decline in outperformance, then it picks up again. So we can only assume the reasons behind that development, and funding costs of the bank might be one of the reasons, but we come to that in a minute. To sum up, I've shown you a lot of examples on the S&P 500 index. We just wanted to make clear the potential for outperformance is not limited to the S&P 500 universe. There's a number of additional indices out there where you can benefit from this withholding tax advantage. 2 of them are purely US indices. That's the MSCI USA and the S&P 600, a small cap index. But you can also achieve a similar result in the MSCI World universe, given the high allocation into US stocks. The outperformance that you can generate from the US tax benefit is still quite significant, and definitely worth considering synthetically replicating ETFs in your investment decision.
Thank you, Michael. Hopefully for all of you, it's been obvious that especially when US equities are involved, that the structure and replication methodology using a swap-based methodology does make sense and can generate some additional value to you as an investor. On the other side, what we need to present and to show you is why would an investment bank be motivated to engage into such a swap contract with an ETF? And as a next point, Michael, also please just allude what is the risk management behind the way we run it, so representative, I guess, for the industry, but we can only speak for ourselves. How do we structure in order to minimize the risk of a swap-based ETF, especially given, you know, the kind of still sometimes memories from products before the great financial crisis, which did have some meaningful counterparty exposure, and we can show you that this is certainly not the case anymore.
Yeah. So in order to understand synthetic replication, a crucial point to understand is what is the role of the investment bank as a swap partner, and what's the motivation of an investment bank. And on the slide before, I just highlighted funding costs, and that's basically one of the major motivations for investment banks to enter into swap contracts with ETFs. So it's the access for the bank to the ETF portfolio. So what we brought you here is quite a simple example, because it's just one swap partner, one investor, and one stock involved. In reality, of course, it's a bit more complex. But let me guide you through this example to make clear what the role of the bank and the motivation of the bank is. So looking at scenario 1, we have an investment bank that sells a future to an investor based on stock X, and is therefore short the performance of stock X. So it's not in the nature of the bank to really have open risk on the balance sheet. So what the bank will do is they will enter a hedging position. In this case, they will just buy stock X and keep stock X on their balance sheet. Balance sheet capacities are constrained. So basically the stock X, having stock X on the balance sheet is not really a pleasant thing for the bank to have, and they need to keep funding costs in mind. So adding an ETF to this equation, and that's scenario 2, is really a benefit for the bank. What will the bank do when we add this ETF to the equation? Well, they can just shift stock X from their balance sheet into the ETF portfolio. And when you remember what I said in the beginning about synthetic replication, it's basically an exchange of the target index performance versus the collateral portfolio performance. So the collateral portfolio of the ETF in this case would consist only of this one stock, of stock X. The bank would still receive the performance of stock X that they can pass through to the investor. And they would have changed the short exposure in stock X against the short exposure in the S&P 500 index in this example. So what the bank can do now with this short S&P 500 exposure is to hedge it, for example, through a future contract. A future only requires small margins, is much less funding relevant than a physical position on the balance sheet. And overall, this S&P 500 short exposure is much easier to handle for the bank than the short exposure in a single stock. So basically, the bank has the ability to outsource hedging positions into the ETF portfolio. Keeping this in mind, we should always be a bit skeptical around the collateral baskets of ETFs, because obviously the motivation of a bank is different from the motivation of an ETF investor. When you're an ETF investor, you want to have a diversified, broad portfolio, liquid portfolio as collateral. That's not necessarily the exact intention of a bank. So it's important for a provider to really define strict rules which securities are allowed as a collateral inside an ETF. So I brought you a quick overview of what we do. It's important to highlight that all major players have strict risk management rules in place, so it's nothing special what we do here. The reason we picked our model is just that I can give you a bit more insights. So first of all, we define a universe of eligible markets and eligible stocks that you can see on the right-hand side. So it's only the major stock exchanges where we really have liquidity and also price transparency for all the listed securities. In a second step, we apply a lot of risk management tools. For example, we want to ensure diversification in the collateral portfolio. We want to avoid concentration risks. But we also want to have, and that's an important point, a positive correlation to our target index. That's something that was not always the case in the past, but is kind of common market practice nowadays. There's various reasons for this. One reason is the higher the correlation between your collateral portfolio and your target index, the less swap rebalances are required. Another argument is kind of a worst case scenario. So worst case would mean that your swap counterpart will get bust, will not be able to provide the promised performance of the target index. In that case, you as an ETF investor would sit with your collateral portfolio, and obviously the higher the correlation of your portfolio with your target index, the less your worst case risk. Looking at some other risk management tools in more detail, and again, that's something that's common market standard. So we apply a multi-swap counterparty model. That means we do not just work with one swap counterparty, but have a number of swap counterparts. You can see the list here. So it's the major global investment banks that we're cooperating with. The more important part from a risk management perspective is how we do the collateral management in terms of swap exposure. So whenever your collateral portfolio has like less performance than your target index, the investment bank, the swap partner, will owe the ETF money, and that means risk to the investor, and that's basically the swap exposure, how we call it. So what we do is we don't have an external collateral management, but we manage the collateral directly between the ETF and the swap partner. And at the end of each trading day, we look at the swap exposure with each and every counterpart. And as soon as this swap exposure exceeds 20 basis points for the larger ETFs, we will do a swap reset. That means the investment bank, the swap partner, will need to provide additional collateral into the portfolio of the ETF, so that the exposure or the value of the swap is reduced back to zero. So in a worst case scenario, end of day, when we have 5 different swap counterparts for one ETF, each of the counterparts has a swap exposure slightly below 20 basis points. We will look at an open risk of around about 1%. It's important to say it's an end of day calculation. So within a trading day, the risk can be slightly higher in volatile markets. We also wanted to give you a real life example, and that's just a screenshot from the website regarding the counterparty exposure of an S&P 500 ETF. It's a bit hard to make out in this presentation because the line is yellow on a white background. Sorry for that. But what you can see here is basically everything above the x-axis is a counterparty risk for the ETF, because the swap counterpart owes money to the ETF. Everything below the x-axis is not really relevant for you, because that means that the ETF needs to pay something back to the counterparty. So when we look at everything above the x-axis, you can see in most of the cases we really stay within this 1% limit that I've just described. There's one outlier in March 2020, extremely volatile markets, when the swap exposure jumped intraday to 2%. But what you can also see is it was immediately corrected. So end of day, the swap counterparts had to provide additional collateral, and the exposure swinged to the opposite direction, which is good for the ETF investors.
Thank you, Martin. And that was a lot of information. Yes, that was a lot of information to you, I suppose, depending upon your previous knowledge and where you come from on your knowledge and your experience with ETFs. But we really hope this was of value to you, to show you actually that both replication methods in equities, physical and synthetic, are valid ones. So it's not just that we want to speak just for the synthetic replication. It can have its benefits, and that's what we wanted to highlight, which would be especially in US equities, where you have the withholding tax effect, but it also can be of interest, let's say, in European strategies, European equities, where you can maybe avoid the transaction taxes, financial transaction taxes, that are in place in a couple of countries. That would be another application, but the most prominent, the most obvious case is the fact for US equities. A second topic that we want to raise, and we'll be briefer on this than on the first one because it's less technical, but we could also spend hours on this, is the topic of ESG, and especially on ESG and ETFs, and to what extent you can use ETFs in order to have a meaningful ESG consideration in your allocation.
Yeah. So when talking about ESG, it's important to understand that ecological, social, and governance issues basically make or touch a lot of topics. So what we try and illustrate here on this first introduction slide is basically ESG is not always so straightforward. As I said, it touches a lot of different aspects. And each and every investor basically needs to define how he or she interprets ESG and where to set the focus when investing according to ESG standards. Keeping this background in mind, so ESG quite a complex space. It's potentially interesting to look at what the regulation is doing, where the regulator is coming from. I mean, we're just about to see the SFDR regulation coming in with Article 8 and Article 9 funds. But what is the background of the regulator? And it's basically the Paris Climate Conference in 2015, where a lot of countries agreed to keep global warming below a 2% mark. Keeping that in mind, it's no surprise that when it comes to regulation and it comes to the focus of the regulator, the carbon emissions are definitely on top of the list. That's also something a lot of investors apply to their portfolios. At the moment, carbon emission seems to be the predominant topic. But not to forget that the E factor, the ecological factor, spans much broader range than just carbon, and the S and G also exist. Looking at carbon footprint in a bit more detail, there's a metric to measure the carbon footprint of companies, and that's the scale of Scope 1, Scope 2, and Scope 3. Sometimes there's a bit confusion what those scopes exactly mean, and that's why we wanted to give you a definition here. So Scope 1 is basically just the direct emissions of a company. So if you have a factory, it's basically just the emission that comes exactly from this factory, and does not include any other parts of the value chain. Scope 2 has some additional requirements because Scope 2 also includes the energy and basically the heating, cooling, and steam generation that's required for a certain company in order to produce its products in order to operate. And then Scope 3 is what most people have in mind when you talk about carbon footprint, and that's both the upstream and the downstream value chain. So it includes all the products that are needed in order to fulfill a certain service, but it also includes the downstream value chain, so basically the delivery of products and the carbon footprint of the products that a company is producing and selling. When we talk about carbon footprint in an investment context, usually we do this based on Scope 1 and 2. The reason is that to get Scope 3 data is a bit tricky. As you can see, there's a lot of aspects involved, so the data quality is not yet there where it should be. So whenever we talk about carbon footprint in an investment context, it's usually Scope 1 and Scope 2. When it comes to implementing ESG strategies in a portfolio, in an investment strategy, there's basically three major approaches to do that. One is exclusions. That's probably the most simple approach. So you as an investor look at the universe of potential companies you can invest in, and then you decide which companies do not fulfill your criteria and which basically get a negative screening and are not eligible for an investment. The second aspect is best in class. Best in class is slightly different because it's a relative approach. in a best-in-class approach, you would look at a certain group of companies. Usually, you just use a sector or an industry group, and then you would invest in the best-ranking companies from an ESG perspective within this industry group that you're looking at, and just cut out the companies that do not fulfill your criteria on a relative basis. That's important to keep in mind. The third approach of ESG investing is engagement. So engagement basically means that you as an investor become an active owner. You make use of your voting rights. You engage with companies. You proactively approach the management of those companies. Tell the manager where he can improve in terms of ESG matrices. And where you really use your share in the company to change the behavior of a certain company. When it comes to diversification and to the effect on your portfolio, it's important to keep in mind that exclusions in best-in-class have totally different risk profiles. Engagement can be done with any company, so it's not included on that slide. So let's look at exclusions in best-in-class. Starting with exclusions, I mean, the clear advantage is that you strictly avoid companies that are involved in topics that you do not agree with. I think a great example is controversial weapons. Most investors do not want to invest in companies that are involved in the production of controversial weapons. So exclusions allow to just scratch out those companies from the investment universe. Given that the exclusion of companies is an absolute approach, it has a big disadvantage, and that's that you significantly reduce your diversification across certain sectors. For example, if you focus on carbon emissions, it's highly unlikely that the energy sector will have a high allocation in your portfolio. The production of energy is quite carbon intensive endeavor. So the risk is that you would scratch out the whole energy sector from your portfolio. On the other hand, best-in-class approaches have the advantage as a relative approach that you would keep allocation to each and every sector. So to stick with the energy sector, if you want to invest in the top 50 names, you would still allocate into this sector, but only scratch out the lowest 50% of that universe. So you still have sector diversification. The disadvantage from a diversification point of view is that by implementing best-in-class approaches, you significantly reduce the number of shares that you can invest in. So if you want to invest in the top 50% of stocks, by definition, you cut out half of your potential investment universe, which is not really beneficial from a diversification point of view. Looking at ESG and ETFs, I think it's a great combination. What we try and highlight here is some advantages that an ETF bring in relation to ESG investments. So on the right-hand side, you have the general features of ETFs. On the left-hand side, you see highlighted in green the advantages with respect to ESG. I think one of the most important topics is transparency. So as an ESG investor, as we mentioned in the beginning, you might have really specific criteria where you set your focus, and you clearly need to know how an investment strategy works in order to determine if it meets those criteria or not. For an ETF, you generally have two layers of transparency. One is that the ETF tracks an index which follows a clear index methodology. So you can read this methodology and see if it fits your needs. The second one is that you have daily transparency regarding the portfolio. So you can look at each and every position of the ETF and determine if the goals from an ESG perspective are met. Two other advantages: shareholder rights. Sometimes you read in the media that assets invested in ETFs are kind of dumb money or lost money from an ESG engagement perspective. That has changed dramatically. So most major providers use the shares held in ETFs to execute their shareholder rights. So there's no disadvantage in at least physically replicating ETF. And the last aspect here is the ETF is really a democratic investment vehicle in a sense that it allows both institutional and private investors to access certain market strategies. As an institutional investor, you can always go to an asset manager, ask him to set up a mandate and to implement certain ESG criteria. As a private investor, usually you don't have this option, but through an ETF, you also have access to interesting and relevant ESG strategies. To sum up, we wanted to bring you a real life example, because everything I said was a bit theoretical. So how does it look in practice? What we brought you as an example is the S&P 500 ESG index. When you remember the implementation of ESG with exclusions and best in class, that's exactly what this index is doing. So step one is S&P will exclude certain companies from the universe, companies involved in controversial weapons, in tobacco, in thermal coal. Step two is a best-in-class approach, where for every industry group, S&P targets the top 75% of that group from an ESG perspective. So this is, as I said, a real-life example of how those different metrics come to work. When we look at the results on the next slide, in comparison to the standard S&P 500 index, you can see that the industry breakdown is not dramatically different from the standard index. So you still have a high diversification across different industry groups. When it comes to the carbon intensity, and that's the second bar on this chart, you can see that the S&P 500 ESG significantly reduces the carbon intensity versus the standard index. The main reason for this is the exclusion of thermal coal, because thermal coal companies rank amongst the worst polluters in the universe. So by excluding those companies, you can significantly improve your carbon footprint on the index. To sum up, we wanted to kind of bring it all together and show you that synthetic replication can also bring a benefit in ESG investing. So what you see on the left-hand side of the chart is the performance of a synthetic ETF tracking the S&P 500 ESG index versus a physical ETF tracking the S&P 500 ESG index. Again, you have a significant advantage in terms of withholding taxes for the synthetic replication, which generates quite a significant outperformance here. Please keep in mind when looking at the chart, the March period was not really beneficial for the physically replicating ETFs. It was a really volatile market environment, so the ETF lost quite some outperformance there. Still, even if we correct the chart for this exceptional market phase, the synthetic ETF would show quite some outperformance. On the right-hand side, you can see that from an overall performance comparison versus the standard S&P 500, it was an advantage to be invested in an ESG strategy, because the ESG ETF outperformed the classic ETF by around about 1% over 1 year. So you implemented your ESG view in your portfolio and at the same time generated some outperformance versus the standard index.
Thank you very much, Michael. We are now coming to the end of our presentation, and I see in the chat there are a couple of questions coming in, so we'll be more than happy to engage on those questions, and looking forward for you, Ernest, to raise those questions with us, and Michael and myself will try our best to answer them. Just let me conclude by just highlighting very briefly about the product range that we have, and you can see all the details of this on our etf.invesco.com webpage. Just to highlight, we have a broad range of, as I said, more than 135 products, be it in equities, be it in what we call then smart beta or thematic topics, be it in fixed income, be it in commodities, and be it in the ESG space. And especially on the latest category, there are a couple of new products being launched as we speak. So that would be all from our side. We hope this was of value to you, and we thank you a lot for your attention. And please feel free to use the chat to ask questions to us, or reach out to any one of us after this. Thank you very much.
Okay, thank you for your presentation, for insightful presentation. We have a couple of questions. For start, very easy question. How do you see passive investment in 5, maybe 10 years? Who wants to answer this question?
I may start and then head over to Michael, if I may. So I guess the question you have to differentiate a little bit, because passive investing does not necessarily mean ETF. You can have also passive funds, traditional wrapper. So what's important, I guess, for the audience is really to understand the ETF as being a wrapper. So in a wrapper like an ETF or a traditional mutual fund, actually you can do whatever you want. And coming out of the rise of ETF over the last decade or so, it's been mainly associated with passive investing, with replication of indices, be it synthetic, be it physical, what Michael just explained, but it can also be an active approach inside an ETF. So, and that's a tendency that starts now or has recently started, and where we definitely see a bigger part of strategies that used to be wrapped in a traditional mutual fund being wrapped in the ETF, because that's something we haven't really touched on today here, is that the big advantage of the ETF as a wrapper is the cost fairness, that actually everybody bears his own trading costs and they're not grouped to the other investors in the same strategy. So in a mutual fund, if you're a long-term investor and you've got many investors going in and out of that strategy, you bear a part of their trading costs, which is deducted from your portfolio. Then you've got swing pricing and all those methodologies in order to compensate for this a little bit. But the big advantage of the ETF, and that's why it will continue to gain market share, is that actually everybody bears its own trading costs, and so it's the much fairer thing to do.
Okay, now it's more difficult.
Yeah, Michael, certainly something to add to this.
I fully agree. So talking about the ETF wrapper, it's a really efficient wrapper, and I see a great future for this wrapper. I mean, what you saw in the numbers, like 20-25% growth rate, is definitely something where you can find reasons behind that. When it comes to passive investing, the question is always how would you define passive? I mean, we've seen a strong trend towards smart beta strategies, which are not the standard indices where the constituents are weighted based on market capitalization, but where constituents are weighted based on, let's say, factor exposure or based on certain exposure to certain themes. So the line between active and passive is kind of blurred, and it's difficult to really distinguish where does a passive end and where does active begin. But certainly I see a great future and hope to see a great future.
Okay, now a question from me, not from chat, but because I think, in Poland, 80% of people keeps their money in banks. In the USA, American, 80% invest in capital market. What should we do to change this proportion in Poland? I know it's difficult.
If I may ask, and that's without being expert on the Polish behavior of retail investors, but I think it's the same in most countries here in Europe. And I guess what we all together as being part of the financial community is really to give a helping hand to investors out there to increase financial literacy. And today's event is just a perfect proof of this. And I think the Warsaw Stock Exchange here is very much on the forefront of doing this, and this should be done also in many other countries, events like this, and just all us together, be it intermediaries, be it banks, be it asset managers, be it the news, we all together need to deliver and to build trust. And I guess that's kind of the backlog where we are coming from, that with all the issues we had in the past and some defaults and the great financial crisis and all the things, a lot of trust and confidence in the financial sector as such had been destroyed. And it's up to all of us to not only live the word of compliance and integrity and all those things, but really to transmit this on a constant base. And I guess the broad increase of ETFs as a vehicle of choice for many investors is just proof to this, because it's efficient, it's transparent, there are no hidden costs. There's no counterparty risk or close to no counterparty risk in there. And these are all things which might help, investors try to tip the feet in that basin of financial markets.
Yeah, I think if I can add to that, basically when you compare the US to any European market, and it's not just Poland, it's a lot of European markets. I'm based in Germany. We have a similar picture here. So basically, when you look at the investment culture and the investment landscape, that the US is very much driven by IFAs. So there's a lot of wealth management consultants for smaller investors who make it easy for those investors to invest. And that's potentially something that we need to change. We as an industry need to change. One approach can be solution-driven investment approaches, where you do not ask an investor to make to pick a single stock or pick a single ETF, but you give him a portfolio based on a certain risk matrix or risk profile, and make it really easy for him to invest. But you also need the people to explain what's happening in this portfolio, because I think that's the European nature, that you really want to understand what's going on with your money. So I think solutions might help.
Thank you. I think, Michael, it's for you next question. Do you see, it's from chat, do you see any advantages of synthetic replication on markets other than US equities?
Yes, absolutely. And I think that's a great question. So I think the most obvious example to give you is the commodities market. The commodities market is a market where you cannot really invest physically. So you need to invest through a derivative or through a kind of a swap structure. So what synthetic ETFs offer you is access to a lot of markets that are otherwise hard to access, as the commodity markets. It also brings advantages in markets that are a bit harder to replicate, like emerging markets. When you cross different time zones, it's sometimes challenging for a physical manager to really get the replication right, especially when you have stress scenarios like we've seen in March this year, where literally every provider had a couple of products that struggled in terms of physically replicating. And the last advantage, and that's something we did not highlight today because it's a bit more complex to explain, is the trading costs. So there's a lot of markets, especially in Europe, where you need to pay a financial transaction tax when you trade a stock in a certain market. The best example is potentially the UK, where you pay around about 0.5% if you want to trade a stock on the exchange. By synthetic replication, you can avoid those trading fees and significantly bring down your trading fees, especially for tactical investors with a shorter term approach.
Thank you. And maybe another one, the last one. What are the most popular underlying for ETFs globally?
Yeah, I think it's not a secret. So looking at the global ETP landscape, the largest ETF by far is the State Street S&P 500 ETF in the US, which is I think around 300 or 400 billion in just one ETF. When it comes to most relevant underlyings, I would say at the moment it's still the standard indices like S&P, Nasdaq, Euro stocks, MSCI Europe, MSCI emerging markets. Because when you think about where the ETF industry is coming from, it was exactly those indices that marked the start of the ETF development. And so a lot of investors use those strategies to implement the strategic asset allocation. They have a lot of confidence in those strategies. Those strategies are big. They have a strong track record. So we still see highest demand in the classic beta building blocks, as we would call them. Nevertheless, I think we've highlighted this in the beginning, there is strong demand for thematic just coming up, and especially ESG, given the regulatory pressure that's increasing.
Thank you. Michael Huber and Markus Poscher from Invesco. Thank you for your presentation. Thank you for being with us. And that's all for now. Dziękuję Państwu serdecznie za to, że byli Państwo z nami.
Thank you, ladies and gentlemen, for bearing with us throughout the past 3 days. Our Warsaw Passive Investment Conference has just come to an end. 3 days of fruitful, interesting deliberations, presentations of experts from Poland as well as from all over the world. Thank you for being with us. And let me point out that we had people from all continents watching, so hundreds of people tuning in. So those of you who are here will be able to tell their friends that this conference can be also viewed on conference streams of our Warsaw Stock Exchange. So follow us on social media. Thank you so much for your presence and see you in a year. Ernest Bodziuk, bye.